Welcome to our companion podcast on important family business matters, Family Business Briefs, with our AI hosts, Jen and Ted. The content in these episodes comes directly from Family Enterprise USA and can be found at familyenterpriseusa.com. As we all know, many issues like taxes, economic policies, and new legislation affecting family businesses are complex. So, with the assistance of AI and our AI hosts, Jen and Ted, this technology helps make sense of it all in a brief, clear, and lively discussion, and all in about 10 minutes. We hope you find the information presented here useful and entertaining. Now, let's listen in on this episode's important family business topic.
Welcome to the deep dive.
Okay, so today we're digging into this huge new tax legislation, HR1, the big omnibus package.
That's right.
But we're looking at it through a really specific filter you asked for, family-owned businesses.
Yeah, and that's, it's such a critical group. I mean, we're talking about the country's biggest private employer. These businesses constantly juggle things like, generational planning, liquidity, and the tax code is always right there in the middle of it.
Right, and we've got this analysis here from Family Enterprise USA, and their goal was pretty straightforward. Find the wins.
Yeah.
What in this bill gives these businesses some stability, some opportunity?
Exactly. What can they actually rely on?
So our mission today isn't, the whole economic picture. It's about pulling out 5 key things, 3 big ones on tax rates and permanence, and then 2 really interesting structural fixes almost, things that should make these multi-generational businesses breathe a bit easier.
Okay, let's do it. Where do we start?
Well, let's start with maybe the biggest win, which was actually inaction. Yeah, sometimes the best move is no move at all.
Exactly. So, win number 1, the top individual income tax bracket didn't go up, stayed put.
And that was genuinely the number one worry for a lot of these family businesses. Seeing that top rate go past 37%.
They were really concerned it could climb much higher, weren't they?
Oh, yeah. The source material confirms lawmakers were kicking around numbers, well above 40%. And maybe even scarier was this idea of an income surtax.
Right, like an extra layer just for the highest earners.
Exactly, which would have just sent the effective rate through the roof for, successful business owners, people investing in growing things.
And the analysis is pretty blunt. It says that surtax idea, it got killed, completely taken out of the final bill.
Which, given the debates we heard, holding the line at 37% feels like a pretty solid defensive win. Not just holding steady, but actually stopping something potentially much worse.
Definitely. And it's not just that the rate stayed the same, it's the certainty aspect too, right? The analysis highlights that this 37% rate is now permanent in the legislation.
Yes, permanent. And for businesses planning years, even decades ahead, knowing that rate isn't scheduled to jump up is, well, it's huge. You need predictability for long-term capital planning.
Okay. But let's dig into that 37% rate a bit, because it highlights a key structural point for anyone listening who runs one of these businesses. We need to be clear how they're usually taxed.
Crucial context. About 80%, maybe even more, of family businesses are set up as pass-throughs. Think S-Corp, partnerships, LLCs.
So the business itself doesn't pay the tax.
Right. The income, the profit, passes through to the owner's individual tax returns.
Meaning they pay their individual rate, potentially up to that 37% on their business profits?
Exactly. And that's the basic unfairness the source talks about. A big C Corp pays a flat 21%. But the local hardware store set up as an S Corp, they could be paying almost double that on their earnings.
So keeping the individual rate at 37% at least keeps that gap from getting wider, even if it doesn't close it.
Precisely. It contains the disparity. It's a fight about parity just as much as the rate itself.
Okay, that makes a lot of sense. Let's pivot to the second big win. This one always gets Congress's attention. How our Congress's attention, the estate tax, or, the death tax, as it's often called.
Always. This is make or break for passing a business down through generations. A bad estate tax situation can force a sale just to pay the IRS.
Yeah, decades of work potentially wiped out. So the win here, according to the analysis, is an increase in the lifetime exemption.
That's right. The amount you can pass on tax-free. It went up.
What are the numbers?
It moved from $14 million up to $15 million per person. So for a married couple, that's $30 million they can transfer without triggering the estate tax.
And connecting back to that first win, the key word again seems to be permanent. Why is making that $15 million exemption permanent so vital?
Think about how these businesses plan. It's not quarter to quarter, it's generation to generation, 20, 30, 50 years out.
Right.
If that exemption number bounces around every few years, How do you plan? How do you set up trusts or buy-sell agreements? Making it permanent, or at least legislatively permanent for now, gives them a stable number to work with. It's about long-term certainty.
That predictability seems invaluable. Okay, let's hit the third major area, capital gains. Another one that Congress always seems to have in the crosshairs.
Absolutely. Capital gains taxes hit profits from selling long-term assets. It looks like easy money for the government sometimes.
But for family businesses, these aren't just stock market plays. This is often, what, real estate shares in related companies?
Exactly. The building they operate out of, maybe some land they bought years ago, investments that provide a cushion or retirement funds. These are core assets.
And the win here is simply no change, no increase in the rates.
Correct. The rates were protected, which is significant.
Maybe quickly remind us of the structure there, short-term versus long-term.
Sure. Short-term gains, so assets you hold for a year or less, they get taxed just like regular income. So rates from 10% up to that 37% top rate we already talked about.
Okay.
But long-term gains, assets held over a year, that's where you get the better rates. Currently, those range from 0% up to a maximum of 20%.
So keeping that 20% ceiling in place is the key win. It protects the return on those long-held investments.
Definitely. It means owners can eventually sell assets for retirement or reinvestment without facing a sudden, much higher tax bill.
But sticking with our theme, does that pass-through structure create another disparity here with capital gains too?
It does, yeah. It's that recurring issue. A C Corp, selling an investment, pays the flat 21% corporate rate on the gain.
Okay.
But the owner of a pass-through business selling a similar asset, they could pay up to that 20% individual long-term rate. Plus, sometimes there's the net investment income tax on top, another 3.8% in some cases.
Yeah.
So yeah, it's still not quite level, even on investment profits.
That underlying difference, that kind of structural issue, actually sets up the next 2 points really well, the bonus wins you mentioned. These sound like direct attempts to address that pass-through problem.
I think that's exactly what they are. Lawmakers saw the gap and tried to build a bridge. The first one is Section 199A.
Right, the source called this the legislative workaround. Explain 199A for us.
Okay, so 199A is specifically designed to help these pass-through businesses, the S-corps, partnerships, LLCs. It gives them an extra deduction, specifically 20%, on what's called qualified business income, or QBI.
A 20% deduction. Let's make that practical. If someone's in that top 37% bracket, how does this 199A deduction actually change their effective tax rate on the business income?
It lowers it quite a bit. Basically, you only pay tax on 80% of that income because of the 20% deduction. So do the math. 80% of 37%. You end up with an effective rate around 29.6% on that specific income.
Okay, so still not down to the corporate 21%, but it definitely shrinks that gap. Instead of a, 16-point difference, it's now less than 9 points. That's a pretty big adjustment.
It's significant. It helps level the playing field somewhat without needing a massive overhaul of the whole tax system. And since most family businesses are pass-throughs, keeping 190I intact is a really big deal for their bottom line.
Makes sense. Okay, the final bonus win. This one sounds like it's all about encouraging investment, restoring full R&D expensing, research and development.
Yes, this is huge for any business that invests in developing new products, new processes, or needs expensive new equipment domestically.
Why was the old rule, the one this bill changes, so bad for investment? What was that capitalization requirement?
It was pretty tough. It basically meant if you spent, say, $1 million on new R&D equipment or a big project, you couldn't deduct that full million in the year you spent it.
You had to spread it out.
Exactly. You had to capitalize the cost and deduct it slowly over several years, maybe 5, maybe even 15 years, depending on the asset.
Which kills the immediate incentive, right?
Well,
The tax break gets delayed.
Massively. It makes the upfront cost much harder to swallow because the return, the tax benefit, is pushed way out into the future, discourages big bets on innovation.
So the win is bringing back full expensing. How does that work now?
The new bill lets businesses deduct 100% of their domestic R&D costs in the year they incur them. Write it all off immediately.
That makes those investments much more attractive from a cash flow perspective.
Absolutely. It lowers your taxable income right away. This part starts fully in 2025, according to the bill.
And there was something extra in the analysis, something about it being retroactive.
Yes, and this is a potential immediate cash infusion. They made this full expensing retroactive. So businesses that were limited by those old capitalization rules in the last few years.
They could get money back.
Potentially, yes. They might be able to amend their tax returns for 2022, 2023, maybe even claim it for 2024, and get refunds. That's real money they can use right now for decisions being made today.
Wow, okay, so let's pull this all together. We've got 3 wins focused on permanence and stability, the 37% top rate, the $15 million estate exemption, no capital gains hike, and then 2 really important structural patches, 199 and R&D expensing, trying to fix that pass-through disadvantage. Seems like a pretty positive outcome for family businesses based on this analysis.
It does look quite favorable on paper, yes.
Yeah.
But there's always the but, isn't there? The source finishes with that necessary dose of reality.
Ah, yes, the Washington, D.C. reality check.
Nothing is ever permanent in Washington, D.C. That's the quote.
It's the constant shadow over any long-term business plan, that political uncertainty. What specific worries did the analysis mention beyond these tax wins?
Well, 2 main things that kind of hover over everything. First, elections. Every cycle brings new politicians, new proposals, often aimed directly at reversing things like this. So even permanent laws need constant defense.
You can't just relax.
Nope. And second, tariffs. The whole question of whether current tariffs stay or even go up, that hits supply chains, cost of goods, completely separate from income tax, but it creates huge economic instability.
So for you listening, running a family business or maybe working for one, what's the big takeaway here? The analysis seems to say these wins are great, but they're not the end of the story.
Not at all. The message is really about continued engagement, making sure the voice of these businesses, all 32 million of them, is heard consistently on Capitol Hill. Advocacy is key to keeping these favorable conditions.
Right, you have to keep making the case.
Constantly.
So here's a final thought to chew on. How stable can things really feel when you have these key provisions, like the 37% rate or the $15 million exemption, labeled permanent? But everyone knows that permanence is fragile. It's threatened by every election cycle and by totally separate economic forces like trade policy and tariffs. It really highlights the tightrope walk that running a family business today involves, doesn't it?
It really does. A constant balancing act.